The scare from the Fed and the dot plots, at least 2023. Now Bullard says, oh, hang on, I'm in the 2022 camp. That's next year. We're seeing dollar just spike. You don't think this is going to last, though?
No, I don't, Marty. I mean, look, there's a couple of things that have happened. Number one, the market on the rate side has shifted its focus away from long-term interest rates and tapering to the front end of the yield curve and the timing of rate hikes. Now, in terms of the dollar, for the dollar to keep rallying, I think you have to believe that the Fed is raising rates in isolation. And the reason we're still, subscribing to the view of dollar weakness over time is that there are a number of central banks around the world, both in developed and emerging markets, that are also looking to raise rates, and in many cases before the Fed. And so I don't think it's fair to say that the dollar should rally because the Fed is going to be out in front of the rest of the world. I think what has happened over the last couple of days is a realization that the Fed's timing is a little earlier than people had assumed. So I think this is a short-term FX reaction.
Hello and welcome. Don't worry, you are tuned into the right place. That was one of my panelists speaking earlier on CNBC, and we're going to delve more into what he was talking about just up ahead. I'm Anisha Tank, and on behalf of Standard Chartered, it leaves it to me to tell you how grateful you are that you could be here. Welcome to this economic and strategy outlook for the second half of 2021. Before we get started with our 45-minute discussion, let me just point you to some of the housekeeping today. We will be running a concurrent Q&A. So if you want to send in your questions, I will be able to see them in real time, and I will put them to our panelists as and when they come in. Please do let us know who you are. Even better, let us know where you're writing in from and to whom you would like to address your question. So the latest report from Standard Chartered points to two major themes, and you saw Eric picking up on some of them just there: uncertainty and unevenness. Some nations are already beginning to liken COVID-19 to the flu. They're calling it endemic, whilst others are still battling wave after wave of this deadly disease. And against this backdrop, surprising trends have begun to emerge. So we're going to take a closer look, a bit of a deep dive. Joining me then, Eric Robertsen, Razia Khan, and Kaushik Rudra. Always good to see the three of you. Eric is in Australia, where he is having to bear the brunt of tightened restrictions at the border. We have Kaushik in New York, where perhaps there's a new sense of normal developing, and Razia is dealing with the usual London weather in the UK, where many are talking about what the summer has in store when it comes to COVID-19. Guys, always great to see the three of you. Let's get straight into the conversation. And Eric, I want to begin with you because we talked earlier in the year about US exceptionalism, but that's not what we're talking about anymore. You said it was probably overstated, and it looks like you were right. But why should we care?
Well, look, Manisha, I think it's a great way to start the conversation. A few months ago, we argued that, as you say, the notion of U.S. exceptionalism was overstated, but not because we were negative on the U.S. economic outlook. In fact, we were quite constructive. But what we were concerned about or trying to raise the flag about was that we thought a lot of market indicators, especially U.S. interest rates, were really pricing in a very, very good economic outlook with very little risk. And included in that was heightened expectations around U.S. fiscal stimulus, a very aggressive view on U.S. inflation and how the Federal Reserve might react to that. And we argued that there was an even chance that maybe some of those heightened expectations would not be met or would not be delivered upon. What we've seen over the last 3 months is a material decline in 10-year Treasury yields from about 1.8 at the end of March to around 1.4 or just below today. Long-dated interest rate forwards have declined even further. And what we've seen, I think, is a little bit of a settling in of reality. Fiscal stimulus expectations have been significantly cut back. And I think concerns around Fed tapering have declined as well. Tapering is expected to be announced before the end of the year, but the market seems much more comfortable with that. And as Razia and Kaushik will certainly spend some time on, concerns around COVID around the world have certainly picked up with the Delta variant. And so, as I said, the notion of U.S. exceptionalism was overstated, not because we were negative on either the U.S. or even the global outlook, but just because we thought that some of the optimism or the exceptional expectations would have a difficult time being delivered.
Well, we're certainly going to delve into the prospect of tapering just up ahead in the conversation. But as we get into the conversation with all three of you, let me take it to Razia, because I want to stick with this theme of unevenness. How fast have emerging markets and frontier markets recovered since the beginning of 2021, the last time we spoke? And were there any surprising case studies that emerged for you?
So that's the really interesting point, Manisha. When we last spoke about a quarter back, the theme of a very differentiated global economic recovery was pretty key for everyone. We know that there's been a much faster pace to the progress on vaccine administration in developed markets relative to developing markets. And with recent concerns around the Delta variant, we know that this is not an issue that has gone away in any meaningful sense. That said, when you look at the underlying economic data, there's been one point of consistency almost across the globe, and that is when we have seen economies reopen following any COVID containment measures, the general sense has been one of positive surprise. The strength of the recovery, some of the drawdown of the savings that were accumulated during those lockdown periods across developed and developing markets alike, this has been a source, perhaps a somewhat surprising strength in terms of the resilience of the bounce back. The question should be, how long-lasting is this going to be? You asked about where we've seen those particular positive surprises taking place. For a lot of commodity-producing economies, there has, of course, been significant upside, given the strength of commodities, not necessarily a theme that many were focused on at the very tail end of last year, but in line with the global economic recovery, even where we haven't seen consistency in terms of the progress of vaccine administration, the strength of some of those external sectors has been a good source of upside surprise. Of course, we'll talk about the policy implications of this and what that suggests for normalization, but if anything, not leaving aside the grave concerns still around the spread of the Delta variant and what this is going to mean ultimately for the near-term growth outlook, we should not forget the fact that in general, looking at Q4 GDP growth, Q1 GDP growth, even across emerging markets, there have been positive surprises.
There have been, although I feel like things change month on month, and that's something we've definitely been feeling the pinch of here in Asia. On that note, let me pick it up with you, Kaushik, because Asia is still dealing with a patchwork of eventualities, responses to COVID-19. Various economies in the region are really battling deadly waves of this disease, but we have a really different situation here in Singapore, for example, where we're talking about a disease that will become endemic and how we live alongside it, almost like it's the flu. Can you just walk us through where these different economies are on the curve to recovery?
Yeah, Manisha, patchwork is the right word. Clearly, I think there is a wide divergence within the region in terms of how so COVID's impacted the region as well as sort of the response function. Now, Asia's growth continues to rebound in 2021 as economies have started to reopen, vaccination rollout sort of have gained momentum. The two risks to our outlook continue to be what we have seen in other parts of the world as well, extensive resurgence of the pandemic, which results in sort of reimposition of restrictions. That clearly is a concern for the region. And second is a more sustained surge in inflation that damages consumer confidence and forces a premature sort of tightening of monetary policy. So these are clearly concerns for the region. But overall, I think the region clearly in parts of Asia still facing elevated case count, as you mentioned, amid sort of low vaccination rates for some of these countries. And this is clearly a challenge. And as Razia mentioned earlier, I think the developed world clearly has led the recovery process as far as vaccination is concerned. EM and parts of Asia clearly are struggling there, and that's really been the issue to date. Now, when we look at global GDP and trade volumes, I think both are recovering faster than they did during the global financial crisis. This is a reflection of the dynamics in the region, particularly in North Asia. Now, Asia contributes a lion's share of global GDP on a contribution basis, and that's clearly humming along, and that's sort of, been one of the support factors globally. But trade is the other factor. It's a very important driver for the region. It's been doing extremely well. Now, breaking it down country by country a little bit, China's GDP has returned to trend levels and is progressing along the path it was on prior to COVID. So we expect around 8% growth rate this year. Over the near term, though, we are expecting growth normalize somewhat in China, but broaden out. Domestic demand conditions remain strong. So does the services sector, but external demand and manufacturing clearly have started to sort of, suffer or sort of soften a little bit. Trade-driven economies in the region, particularly countries like Taiwan, Vietnam, and Korea, they did very well in 2020, as well as sort of continue to do extremely well this year. But when we look at some of the other countries in the region, we've seen some downward revision to growth expectations with the resurgence of COVID. India, Singapore earlier in the year, Indonesia and Japan, unlikely to return to sort of pre-pandemic GDP levels until sort of Q3 of this year. Countries like Malaysia, probably not before the end of the year, and Thailand and Philippines, perhaps not this year at all, more a 2022 story. So I think with the exception of Singapore, which has obviously done very well on the vaccination front, which is why the story is developing much faster than others, other countries have less than a quarter of their population vaccinated. And I think that clearly is going to be a challenge. The last thing I would say from my perspective is a little bit short comment on inflation in the region. It's been a challenge for the region. Oil prices, base effect, that was expected to cause inflation to go higher in the region, but we've seen some significant supply rigidity sort of cause temporary pickup in inflation. Trade prices, but also food prices in other parts of the region have been impacted. So this is clearly something that will complicate the policy options for authorities in the region. I think monetary policy probably needs to be accommodative to support growth, but at a time when we are seeing inflation pick up, albeit temporarily, this could clearly test policymakers in the region. So I'll leave it there and sort of come back to some of these themes in a little more detail later.
Yep, definitely. Inflation, we certainly will, and it will certainly play into the answers to the coming questions. Before we get to those, and I'm going to pick up with Eric in just a second, a reminder to all of our viewers everywhere that you can take part in this conversation at any time by typing in your questions. Send them to via our Q&A icon, and I will weave them into the conversation wherever possible. Let us know who you are, if you like, and where you're writing in from, and whether or not you have a specific panelist that you would like to target with your question. But do send them in. I've ready and waiting, and I have that real-time feed right in front of me. So, Eric, let's pick it up then and talk about tapering in the U.S. So much talk about this happening right now, and whether or not we need to see a policy shift anytime soon, and whether it's even happening. However, you aren't worried. Why is that?
Well, look, Manisha, the word taper, I think, instills quite a bit of fear in investors, and there's good reason for that, right? The 2013 taper tantrum caused a significant outflow of capital from emerging markets, quite a bit of interest rate volatility across both developed and emerging markets, and really caused quite a bit of strain for a number of emerging market economies. I think the story today is different from both the U.S. side and from the emerging market side. In the United States, we would argue that the quote-unquote taper tantrum occurred in the fourth quarter of last year and the first quarter of this year, when we saw a dramatic increase in long-term U.S. interest rates, a steepening of the yield curve, and perhaps just as importantly, a big increase in real interest rates. Now, the thing that's interesting today is in 2021, a tapering of asset purchases by the Federal Reserve is the worst-kept secret in the market. It will not be a surprise to anyone. And therefore, the shock value from this announcement, when it comes, we think will be much lower. The other big difference today is, COVID aside, and I will come back to that, emerging market economies, generally speaking, are in a much better shape than they were in 2013 for a variety of reasons. Included in that, foreign investor positioning today in emerging markets is much less, especially as a percentage of total bond market size. And that's important because it means that if interest rates in the United States do rise, there's less risk of a serious capital outflow. Another factor that's important is that the current accounts for a number of emerging market economies are much less negative today than they were in 2013. And so we would argue that that reduces the risk or reduces the intensity of that external vulnerability. Now, the key point, though, is when will the Fed's announcement about tapering come, and what does it mean for long-term interest rates, both in the U.S. and in EM? We believe the tapering announcement will come in the third quarter of this year, most likely September. There is a risk that that decision or that announcement is postponed until November. Either way, we expect the actual tapering of asset purchases to start in the new year. Now, as a final point, we've also argued that, like in 2013, when that announcement does finally come, we would argue that that will be the top in both U.S. Treasury yields and Chinese government bond yields.
Eric, can I just ask you a quick follow-up, just to dig a little bit deeper on this? So you've mentioned 2013 as this comparison point, but there are those who would argue that this is a very different time. We're dealing with a very different situation. We're dealing with a pandemic. What are the risks of these comparisons that we make?
Well, look, I think the biggest risk in my mind is that we're just in a much different point in the economic cycle. Today, as Kaushik alluded to and as Razia alluded to, we're in this very delicate balancing act where we have seen a significant economic recovery in many emerging market nations. The one caveat is that a lot of those recoveries have been driven by external demand. They've been driven by exports. And the big question mark for a number of these emerging market economies is domestic demand. Will domestic demand come back in a strong enough way? And when growth starts to normalize or plateau over the next 6 to 12 months, will consumer demand pick up and start to the rebalancing process that Kaushik alluded to? Now, I think one of the big risks as we look forward for emerging markets is that maybe export growth starts to taper off, but domestic demand doesn't catch up, and you're left with a gap between external circumstances and domestic. The final scenario that I would argue is a big risk for EM is this issue of fiscal space and debt sustainability, and something that Razia, I know, will talk about in a few moments. But for me, one of the real things to worry about over the next couple of years is, will the amount of debt that has been issued to get economies to bridge the gap over the COVID crisis, will that debt become a dead weight on economic growth? And I think that's a question mark for the future.
Absolutely. In fact, it's going to be in the future of this conversation as well. But before we get there, let's indeed cross to Razia and talk about some of those issues that you just raised. Razia, essentially, we're beginning to talk about policy normalization, aren't we? Although I feel very wary about that. But for parts of Africa, for example, they're still yet to see major vaccine rollout. In fact, we've had a question on this that's come in asking exactly that. With this slow vaccine rollout, what other risks do we see to the African recovery from the pandemic, especially as the Delta variant that you yourself have mentioned has been identified in certain countries in Africa? It feels to me like normalization is still really far off.
Thank you, Manisha. And I think exactly to that point, and the point that Eric had raised around the sequencing of growth, if there is a potential silver lining here, it's that we're probably not going to be seeing that much disruption to financial markets. When we eventually get to the Fed taper, markets have had lots of opportunity to think about this and the implications of it. But perhaps it'll happen at precisely that point in time when the growth does come back to EM and frontier domestic economies in a much more robust way than has been the case to date. Now, clearly we know that the very uneven pace of vaccine administration is a cause for concern, and nowhere is this more the case than for sub-Saharan Africa. As of the end of the last quarter, we had seen less than 2% of all of the vaccines administered globally being administered in sub-Saharan Africa. There's been a lot of discussion around the disruptions to supply, the logistical bottlenecks in terms of just ensuring the adequacy of supply. We know that this is getting a lot more multilateral attention. Think of the recent G7 meeting. The World Health Organization, though, is increasingly optimistic that with the additional attention being given to this subject, perhaps that supply bottleneck is seen easing over the next 6 months. Now, this isn't going to come soon enough for many of the countries in sub-Saharan Africa, where on current projections, we're not looking at herd immunity from vaccines in 2022. Even in 2023, there is a question mark. But there are still some indications that there's room to be positive. Take South Africa, currently in the grip of its third wave. The number of cases, the COVID infection rates that we've seen recently far surpass anything that was seen during the first and second waves. But economically, we're not seeing the impact of the containment measures having as significant an impact on activity right now as was the case last year when the economy contracted by around 7%. But even more encouraging, what we do know from the recent experience is that once those vaccine rollout programs do start, very rapid progress is possible. Now, there's been increasing talk of expanding the capacity for the manufacture of vaccines within sub-Saharan Africa itself, and this is where a lot of the hope currently rests. We may not be seeing that restoration of herd immunity anytime soon, but certainly for economies like South Africa, an emerging market, significantly more liquid markets than many other economies in the region, policymakers are being consistently forward-looking in terms of talking about normalization. This is the difference between frontier and emerging markets. In the recent past, we've seen rate easing in the likes of Uganda and Ghana, both cases where policymakers were very concerned about the weakness of private sector credit growth given the COVID shocks that they have experienced or are currently experiencing. Somewhere like South Africa, there's a lot of hope, a lot of optimism resting on perhaps faster vaccine administration progress, and also the realization that policy making now, policy is set with a view to what is happening to inflation, what is happening to the negative output gap 2 years down the line, and there is a robust case for normalization. So I would conclude by saying the slow pace of vaccine administration has absolutely been a problem for sub-Saharan Africa. But the recent successes in South Africa, where the pace of that vaccine administration has picked up very rapidly out of necessity, that is a positive theme. And if that should increasingly become the example for the rest of the region, then things might be a little bit more upbeat than had been thought so far.
It feels like a very pragmatic view, and thank you for that, Razia. I also want to say thank you to John Nani from Ghana, who sent a question in about exactly that subject, and I hope that Razia, John, has covered all of that for you. Let's move now to Kaushik and talk about emerging markets in a little bit more detail, and I want to talk about sovereign balance sheets and the kind of damage that they will have seen. Tell us a little bit about that and what that means for valuations, particularly when we're talking about an environment in which we're talking about rate cycles picking up again.
Sure. I think clearly, EM debt sovereign space has seen very large fiscal spending undertaken by most sovereigns on the back of the pandemic. This has resulted in a very large increase in indebtedness with very sharp sort of deterioration in sovereign balance sheets. Now, in a sort of normal world, if there was only one country that had this sort of a problem, I would suspect that that country would see multiple notches of downgrade. But we have seen this across the globe right now. Whether it's a developed market or an emerging market, we've seen balance sheets worsen across the board in sort of response to this. And that has meant that the whole world, in a sense, has sort of taken a downward shift in terms of sovereign credit quality. Now, because it's on a relative scale, it doesn't really matter, but clearly that has happened, and that is perhaps not reflected in spreads. But I wanted to actually quickly take one particular example of a country within Asia that I just wanted to highlight a little bit. I mean, Thailand. This is a middle to high income country with a lot of healthy economic and balance sheet metrics. And prior to COVID, it was sort of humming along reasonably well. It's a very dynamic economy. It's very resilient. We've seen it bounce back very strongly from previous bouts of crisis. But Thailand is very dependent on tourism, and this pandemic has clearly been very negative from a tourism standpoint. The sector will perhaps take a few years to recover. Now, what I wanted to highlight is GDP levels in a country like Thailand will probably not recover to pre-pandemic levels till 2022 because of sort of the hit that is taken. But more importantly, the authorities have had to undertake significant fiscal measures to support economic growth, which has meant that debt levels, which were very low to start with, have sort of shot up above 50% of GDP and starting to approach their 60% debt ceiling, which sort of starts imposing restrictions and impose some degrees of, remove some degrees of freedom from sort of the policy mix that they had. So this is a good example of a country which was very strong from a balance sheet standpoint prior to this crisis, and what sort of impact this crisis has had on various balance sheets. Now, Thailand, I'm quite confident, will be fine because they have a very resilient, they'll find various ways to do things, and they still have a lot of policy, support measures at their disposal. But it clearly begs the question is what sort of impact it has had on weaker economies around the world, and that clearly is the challenge for emerging markets. The thing I would say is that EM spreads currently have performed okay despite what we clearly have seen from a worsening fundamental story on the debt side. They have definitely lagged the spread compression that we've seen on the U.S. credit market side. Now, U.S. credit markets have understandably performed well because the Fed has bought U.S. credit, or at least sort of highlighted that they have possibility of buying U.S. credit, which has sort of underpinned the U.S. investment grade space and supported the high yield space as well. Now, what we see on a relative basis, what this has done is made EM cheap versus the U.S., despite the fact that perhaps EM on an outright basis is not that cheap. But from a relative basis versus the U.S. EM does look cheap. EM high yield in particular looks much more attractive on a relative basis versus both EM investment grade paper as well as versus the US high yield space. So I think that clearly is a sector to focus on. We believe that as vaccination picks up pace, as Razia just alluded to, in parts of emerging markets, we will see the sort of base forming in the economic growth story, and that will allow the growth recovery to take place perhaps in the second half of this year and into 2022, and that's when the market will start getting behind this rally and actually perform, spreads can perform a lot better, more on fundamental basis rather than on the relative arguments that we've seen so far.
But Kaushik, can I just follow up on something? Earlier we talked about the region being a bit of a patchwork in terms of experience at the moment and in terms of the unevenness of the outlook. We've had a question here about, of course, COVID causing a scarring of economic potential output and reduced spare capacity. But as demand picks up and perhaps central banks have to tighten earlier than expected, what happens when spare capacity returns? Now, what this question has made me think about is what happens if your bounce back is way stronger than you expected it to be? How do you respond? Are there risks here in Asia of that happening?
Yeah, definitely. I think we see parts of North Asia, we clearly can see that being a risk where you see things recover much faster. I think when demand starts picking up, along with potential some supply rigidities that sort of stay in the system, you could have a pick up in inflation. And I think that will clearly be a sort of headache for policymakers in the region who would much rather support growth and be a little bit more, relaxed on the tightening front near term. That would be their sort of their bias. But clearly they may be pushed to doing tightening measures sooner than they would have liked. And I think that clearly will be a concern for policymakers as we go forward. The fiscal has been a big area of support for a lot of countries in Asia. Perhaps that can get dialed down a little bit as this happens, but monetary policy will probably be the shock absorber during that period.
Okay, Kaushik, thank you for that. And thank you all for the questions that are flooding in now. Looking good, and I will bring them into the conversation wherever we can. We're getting lots on commodities, expectations for oil prices, and also more on frontier markets and Forex expectations. Speaking of foreign exchange, let's talk to Eric now a bit about that. Eric, given the picture that has been emerging over the course of this discussion, what is your view on the US dollar? I know that you touched on it right at the top of the conversation, the Chinese yuan and Asian currencies. Why aren't you bullish on the dollar?
Well, look, there's been something really interesting which has happened over the last month, which is that at the June FOMC meeting, the Federal Reserve forecast changed, and those new forecasts showed that median expectations were for 2 rate hikes from the Fed in 2023. And in some parts of the market, the reaction to that was to turn extremely constructive on the US dollar. And our pushback against that narrative is that if the Federal Reserve was looking at shifting to a more hawkish policy stance, or was shifting in that direction in isolation, we would say, okay, fair enough, maybe that's constructive for the dollar. But what we have to understand is that the Fed is not acting in isolation. In fact, we've seen a number of central banks in emerging markets, including Mexico, Brazil, and Russia, all raise rates already. We have other central banks, like the Bank of Korea, talking about raising rates before the end of the year. And we have central banks in the G10 also talking about policy normalization over the course of the next 18 months. So I think it's very hard to talk about the U.S. dollar strengthening simply because the Fed has made a minor shift in its forecast changes. Now, on the foreign currency side, the view that we've held for the better part of the last 12 months is that currencies in Asia, especially those linked to global growth, global trade, and in some cases the commodities cycle, would do very well. And that has included RMB in China, that has included the Korean won, the Malaysian ringgit, and the Singapore dollar. Now, the dollar down trade, or the bullish trade on those foreign currencies that I've mentioned, has really taken quite a while to materialize. In fact, it's been fairly frustrating. But what I would argue is that in a 6 months of 2021, where we've seen quite a few shifts and changes in the economic narrative, those currencies have been remarkably stable. In fact, the volatility-adjusted performance of currencies like the CNY, like the Korean won and Singapore dollar, have been extremely good. And so the way we're thinking about the second half of the year is that we do expect those currencies to be stable. We expect them to be stable at the upper end of their trading ranges, and we do expect them to outperform. Now, it may not be just against the dollar. It may be against other funding currencies such as the euro and yen. But when we look forward, say, 6 to 12 months, we do still believe that the dollar will ultimately depreciate on a broad basket basis.
Okay, speaking of the basket, thank you for that, Eric. Let's move to a different basket of currencies, and we'll go to some of the local capital markets, frontier markets, and look at Africa for a moment. Gauthier Robinet has sent in this question. Has the pandemic accelerated the development of local capital markets for frontier markets? To what extent are deeper local capital markets in Kenya and Nigeria an advantage for the sovereign or banking sector? I hope I'm making sense of the question. Razia, this one's for you.
So it's been a mixed picture. It's probably fair to say that if there's one thing that does stand out, it's that even when we did see that much more heightened volatility in U.S. Treasury yields earlier this year, frontier markets were remarkably resilient to that. We shouldn't be surprised by that. By virtue of their liquidity, it's the more liquid emerging markets that typically react to what is happening globally. There has been perhaps a cautious an increase in the amount of attention given to high-yielding frontier markets, partly because of the attraction of their yields, the kind of real yield that's very difficult to come by elsewhere, and also this perception that if we were going to be seeing any significant degree of global volatility, Eric has already run through a lot of arguments why we shouldn't necessarily see that translating into dollar strength. But if for the sake of argument it did happen, you wouldn't necessarily be expecting the frontier markets to be selling off all that significantly. Emerging markets have long been seen as being more at risk of when we get those short-lived episodes of volatility. Now, in terms of the actual development of local capital markets, it has been a mixed picture for the following reasons. We know that over the course of the COVID crisis, there were a number of frontier markets in Africa that did become more investable. We didn't necessarily see policymakers putting in place restrictions as to how those currencies can trade, and those have been the ones that have really benefited from increased investor attention as we've come out of 2020. So the likes of Ghana, where real yields remain very compelling, Uganda, with a lot more happening in terms of the primary dealer system, a lot being done locally to try to ensure that these markets are more investable. Somewhere like Nigeria has been a relative laggard, and this has to do with the foreign currency choices, the foreign exchange policy choices that regulators had put in place. The Nigerian market has not been seen as that tradable, that's accessible. There are still issues of trapped funds that investors are having to contend with. The hope is that with a more healthy oil price environment that we've certainly got in place currently, the boost that's going to be seen across the board from the receipt of IMF SDR allocations, a very significant boost to the foreign exchange reserves of emerging and frontier markets alike, that maybe some of these bottlenecks will start to shift. So it's been a mixed picture, but the one thing that does stand out is that where policymakers have focused on a combination of front-loaded fiscal consolidation, trying to put right what went wrong last year, trying to send a clear message to investors that they do care about what debt levels are doing and where they're ultimately going to be stabilizing, and at the same time making the effort to make those local markets more investable, it has certainly paid off for those markets.
Well, you brought up debt. Let's continue with the debt story and take it to Kaushik. There seems to be a lot of nervousness around right now when it comes to sovereign debt. How do you see this playing out? And I know that you were alluding to this earlier when we were talking about some of the issues that we're facing here in Asia for some emerging markets.
No, absolutely. But if I could just quickly comment on what Razia said. I completely agree with everything she said. From an Asia standpoint, one of the other sort of things that we've learned is, the markets that do better during periods of crisis are markets which have strong institutional players domestically. Right, so not only do you obviously need to develop the infrastructure and the support system for the market itself, which a number of smaller countries would be doing over this period, which is very helpful, but also sort of developing the pension funds, the sort of local institutional investor base is very helpful. And I think that has allowed Asia in particular to sort of trade as a low beta market around the world. And I think that clearly has been one of the sectors that has done well during periods of stress. Now, you actually absolutely, talked about a very important aspect of nervousness in the market. This has been around duration, but as Eric highlighted, I think our view has been that we perhaps have seen the peak in treasury rates. We've seen sort of more likely to see more of a flattening bias, but there's definitely a reluctance from investors around the world to sort of extend duration right now. And this is something that obviously we are seeing across both the sovereign debt asset class as well as the local currency debt asset class. Now, on the local side, I think one of the things I would highlight is real yields have narrowed quite substantially with inflation picking up. We've also had fiscal policy, as I mentioned earlier, which has been expansionary, which has meant higher amount of supply, and that has kept investors on the sideline. I think that's been an area of concern. But positioning, as Eric had highlighted earlier in the conversation, has remained very, very low. And I think this is perhaps one of the lowest I've seen for some time. This is definitely a positive. When we do see the sort of macro framework improve somewhat and confidence return for these debt markets, we will see a very large inflow into this particular sector. I think that will be very supportive. The final piece for the local currency sector, where there was nervousness earlier in the year, was the US dollar strength. Now, as Eric highlighted again, I think that was a headwind for the market earlier. Now, as that view starts changing and people get more accepting of that view, we should start seeing EMFX trade with a slightly more idiosyncratic bias rather than sort of the macro headwind that it's been trading under. And I think clearly what we are seeing from investors right now is more acceptance of the EMFX view that is likely a trade that will happen sooner. The duration view probably will take a little bit longer, but that will happen as well.
Okay, Kaushik, I'm actually really glad that you brought up FX again because we've had another question on this. What is the risk to the weaker US dollar view? Could it be stronger than expected non-farm payrolls data once unemployment benefits end? And I think it's worth bringing this up because, you know, obviously the US picture, we've seen the benefits of all of these fiscal stimulus policies, but things are shifting, the sands are shifting. So how do we take that into account? Just very quickly, because we have a few more subjects to get through.
Is this for me?
Yes, this is for you, Kaushik.
No, so I think, listen, I think from an EMFX standpoint, as growth story starts to pick up, and that will happen in the second half of the year, we should start seeing more of a fundamental basis for the EMFX recovery, and that should support. I think the dollar view clearly is one where we've had a very strong conviction for a long period of time, and as that starts to tail off, we will start seeing EM start trading with its own bias, and I think that clearly is going to be much more helpful for the EM economy, managing their own outlook rather than worrying over a bigger currency, which is obviously going to be a drag for them.
Okay, and very quickly, Eric, can I also get your response to that question on this risk to the weaker US dollar view?
Yeah, sure. Look, I don't think the risk to the dollar view comes from better U.S. growth or a better U.S. labor market. I mean, if you take the most recent non-farm payroll report, we saw over 800,000 jobs created. We now have a 3- and 6-month average of about 500,000 jobs. At that pace, it's going to take another year for the U.S. labor market to recoup all of the jobs that were lost from the COVID crisis. And that's not bad by any stretch of the imagination, but it is elongated. Now, I don't think good growth and strong labor markets are all that is required for a strong dollar. What would make me worried is if U.S. inflation and global inflation remained high for a much longer period of time than we've been anticipating. We've very much been in the view of inflation being transitory, but if it turned out that inflation was really maintaining levels in the U.S. of 3.5% or 4%, and that would force the Federal Reserve to become much more interventionist with regards to policy tightening, then I think that would see a much stronger U.S. dollar.
Okay, thank you for that, Eric. I was furiously writing notes because we might come back to a couple of the points that you just made towards the end of the conversation. I want to, though, at this juncture, go back to talking about debt sustainability because, Razia, I think there's a really important question to be asked here around, we talked earlier, and this is what Kaushik was talking about nervousness around durations. As we see the potential for rates to pick up and as we sort of look at the longer term as well, especially, let's say you're getting yourself tied up with a sort of a 10-year note of some kind when it comes to some sort of emerging market bond of, thinking about that, does it really matter? Should we really, even if investors are nervous, even if they're worried, should it really matter at this stage, Razia?
Well, to the extent that market conditions haven't necessarily been wholly conducive year to date to these big inflows into emerging and frontier markets, and an interesting differentiator has emerged, and that means that there has generally been that much more pressure on different sovereigns to do the right thing in terms of front-loading fiscal consolidation while still protecting the recovery as best as possible, sending out messages that might create the confidence that they are putting in place the institutional framework that might be required for the deepening of domestic markets, which Kaushik alluded to earlier, and also more pressure perhaps for actual underlying economic reforms. It sounds almost cliched. There's been a big focus in terms of how things will be done differently post-COVID when we get to that point. What kind of reforms are going to be needed to sustain growth? For a lot of emerging and frontier markets, the focus has been not just on how do we get over the recent widening of fiscal deficits, how do we ensure that we're on a growth trajectory again, because nothing will reassure on the accumulation of debt levels like a faster growth rate and the potential to be able to grow in an accelerated way in the future. But it's also been about about what micro-level reforms might be needed to reassure on those crucial questions around debt sustainability. If we take Africa as a region, we know that we've been back and forth across a number of different initiatives. First, the G20 endorsed debt service standstill initiative, the DSSI rather, with a limited amount of liquidity relief, time-bound, but certainly coming at an important time for affected economies. The idea that some economies would need deeper debt treatment than that under the common framework, how that plays out meaningfully for sovereigns that have issued externally, that's yet to be tested. But alongside all of this is the realization that many sovereigns don't have the luxury of doing nothing. We have seen a lot more countries signing up to IMF programs, the external anchor on the credibility of their fiscal reforms, saying, we will do this as a means of assuring investors that we fully intend to proceed with the fiscal consolidation. Even when things bounce back, the fact that we are front-loading the revenue measures that will, over time, create more sound building blocks for future macroeconomic growth, that we will be in control of those debt levels, these are all important developments. So I think the one encouraging thing about the crisis to date is that things have not happened in isolation. Last year, with the capital outflows from emerging and frontier markets, things were difficult. Looking back a year and a bit on, can we say that there has been a deepening of reform? Can we say that there has been greater commitment perhaps to transparency and to the fiscal reforms that are needed to bring about a more meaningful difference in the longer term? I think the answer to that is yes, and that's what investors should take some encouragement from. Now, it hasn't been a uniform story by any means. There are countries that are reforming fast, and there are laggards in this space. But the building blocks are certainly in place for those more rapid reformers to be rewarded for it.
Thank you for that, Razia, and I hope that that answers your question, Jean-Arsène Yerema, who sent in exactly that, which was basically how investors would react to increasing fiscal deficits in emerging markets due to all of the unforeseen spending. I think Razia covered quite a bit of that just then. Okay, so we are around 3 minutes to the end of this conversation, which has really zipped along very quickly. Before we go, I did promise that we would touch on commodities. I can't help but bring up OPEC and its inability to reach consensus. Razia, you and I talked about this off-air just a day ago. What happens if producers just go it alone and decide to turn on the taps? What are our prospects?
So this is the real risk right now. Standard Chartered's commodity research team have put out a large number of different publications pointing out that the real bounce back that we're seeing in global oil demand is happening right now. It's near term and it's front loaded. And there might well have been a more robust case for relaxing some of those production constraints, but that was not the outcome of the most recent set of meetings. What markets will have to grapple with is, what does this mean over the longer term? Is it a case that come the August meeting we're going to get some sort of agreement in place that production levels will be raised, that we don't need to question the longer term ability of OPEC to hold together? Or is it going to be the case that precisely as we probably see the other side of this resurgence of global oil demand, there will be real concerns about the ability to reach that consensus within OPEC, within OPEC Plus as a grouping. And that could certainly take some of the momentum away from oil prices. As yet, I would say markets are probably undecided about which way this is going to go, but there's certainly a theme that everyone is going to be focusing on as we get further into the third quarter.
Yeah, I'm wondering. Maybe it was too soon for me to ask the question, but thank you anyway, Razia, for tackling that one. And also thank you to Tushar Malhotra, who sent in a question about commodity prices and the outlook. Eric, your last big question of this conversation is really around the fact that we started off talking about the very uneven pathway. I want to know what we're likely to trip on. And we've also had a question from Mayank Jain, who's sort of asking the same question, but has probably put it a lot better than I did. He's pointing out that we're looking at all the DM data through rose-tinted glasses at the moment. What sort of US or European data would actually qualify for a non-Goldilocks scenario, he asks.
Gosh, two very good questions, and I'll try and wrap them up into one answer. And I think this is true for both DM and EM. You know, our baseline view has been that even though growth was uneven, even though there were haves and the have-nots, the haves would ultimately drive a better economic recovery story. And that the instances of the have-nots, while troubling and while presenting challenges, would not be big enough to derail the global economic recovery story that we've been running with. Now, what makes me nervous as we get into next year and the year after is we have an enormous amount of debt that has been piled onto the global economy. And one of the things that people have said repeatedly is that debt is okay because as growth recovers, debt to GDP ratios will come down. And I guess the fear for both DM and EM is, what if over the next 2 years, growth really disappoints? And then those debt to GDP ratios never get any better, and we're left saddled with an unsustainable level of growth. And for many countries and companies as well, the inability to service those debts becomes a dead weight on their economic performance. So I think that's, for me, the biggest concern, or the potential banana skin that I think we need to be worried about over the next 1 to 2 years.
And I'm sure that we will talk about that in the future. Very quickly, the last question to Kaushik. I'm sitting here in Singapore, which last year was sort of called a gold standard when it came to its response to the COVID-19 pandemic. Here we are, coming up to the second half of 2021, and Singapore is talking about calling this an endemic disease, putting it alongside the likes of flu. We started off the conversation introducing this as part of the subject. Has this approach here in Asia for this one small country changed your view at all of the future?
I think there is a pathway. Singapore's clearly shown a model pathway for other countries to follow. But critical in that is sort of obviously a system that they have put in place. Now, some of which obviously they will eventually give up. But I think that system has helped Singapore deal with this crisis a lot better than other countries. So I think that's been clearly a great example. But ultimately, I think it's been about vaccination. We've seen that in Singapore. We've seen that in other parts of the world where, countries have been able to open up. I'm in the US right now. We clearly can see that vaccination has helped and is allowing countries to open up in a much more sustained way. Parts of the US and parts of the world where we haven't seen enough vaccination, that's clearly going to be a troubling theme. So as long as the countries can get to herd immunity, then I think we can accept this thesis and sort of move forward. Singapore is clearly much closer to doing that than other parts of the world.
Okay, well, that's a really positive place to wrap it up. As always, I'm incredibly grateful to the three of you and, of course, to our global audience as well. Thank you for all of your wonderful questions. It was great that you could take part in the conversation today. It just remains for me to say a goodbye to all of you. Goodbye to Eric Robertsen, who's in Australia, Kaushik Rudra, who is currently in New York, and Razia Khan, always with a big smile, joining us from London. To all of you three panelists and to all of our audience, thank you and goodbye.